Welcome back to the Anthony Lee Crypto Channel. Today we are going to be discussing the bull versus bear case for Bitcoin on the macro. Is the bear market bottom in? Is the low in? And is it bull market time? Or is there more downside to come? That's what we're going to discuss. We have several different metrics, indicators, statistics, and things like that to show you, and you can decide for yourself. We'll keep a little tally up on the top to see which one wins. A lot of these stats we're going to show you today are 100%. And let me tell you something, either way it goes, whether the bottom is in or whether the bottom is not in, either way it goes, there will be multiple 100% stats that are broken this cycle. Now, granted, when you're discussing the macro on Bitcoin, you don't have a large sample size. Here we're looking at the Bitstamp chart, which goes back to 2011. So for some of these metrics, you only have 2 or 3 or 4, probably 4 at most examples to go by, but nonetheless, a lot of these are still 100%. They have never been violated, but they will be. Some of them will be. So it's for you to decide which ones will remain 100% and which ones will not. I will simply present the case. Let's start out with the bull case here. Again, I'm on the Bitstamp chart. It has the most history for Bitcoin, and I'm on the weekly time frame. And what I have marked out here, you can see at the bottom, I have RSI, the relative strength. And this bottom dotted line here indicates the 30 line, okay? Anything below that is considered very, very oversold. And you can see we have touched and dropped below the 30 line 1, 2, 3, 4, 5 times in the history of Bitcoin, okay? I've gone through each one of these times we have touched the 30 line and have marked it out with these white vertical lines. I'll turn those back on for you now. And you can see each time that we touched those lines, I'll zoom in a little bit here. Each time we touched those lines, the low, that was the low. The low was in for Bitcoin. I'll turn them off a little so you can see there's some wicks down below these, but that was the low, the bottom of the bear market each time you touched the 30 line. This is a 100% stat. Now, I should tell you, to be fair, that one of these actually failed. And that was this one right here in 2022. Let me slide this to the side just so slightly so you can see. You did come back later and make a slightly lower low. That was the FTX collapse. This was the big scandal. FTX got caught in the scandal. Sam Bankman-Fried, they were dumping coins on the market. They were freezing accounts, panic selling, all of that. So I present the case that it had that scandal not happen, and I acknowledge that it did. So this still counts. Had that not happened, I think the low would have easily been in right here with this 30 touch on the RSI. And even then, you only dropped about, $1,500 or so with the scandal, lower than the low. So it did happen. However, if not for that scandal, that rare scandal, then this is a 100% stat. But it's not. I'm still going to call it close enough for me. I'm going to call it 100% stat. Pending another scandal like that, this is a 100% stat. So, but we can increase the probabilities of this stat holding true at a 100% because even with the FTX, which I just toggled that off, we want to combine this stat. I'm going to lower the RSI and I'm going to pull up Cypher. We're going to combine this stat with the weekly money flow crossover from red into green. Going back to full history of Bitcoin, when you have a bear market or bull market, you can see down below the big, large green areas. Okay, that is when money flow is thick in the green. You're in the bull market. Everything is good. Price is going up significantly, right? Green down there, price is going up. Green there, price going up. Well, eventually at some point you hit a bear market. And when you hit the bear market, money flow eventually crosses to the red, okay? And at some point in the bear market, it comes back and crosses and confirms on the weekly time frame in the green. Once it confirms back in the green, the first confirmation back in the green, sometimes it can flippy-floppy back and forth. Like here you see it going to the green, going to the red, going to the green. But once that first weekly confirmation in the green, I have marked those out with green vertical lines. And you can see each one of these when you got the weekly confirmation in the green. Money flow, the low, the bottom of the bear market was already in each of these cases, including the FTX. Now, you didn't get the weekly confirmation till way over here. However, the low was in, whether you count the original low or the FTX scandal. Either way, the low was in. So I consider the RSI kind of like setting up, okay, the bottom is likely in here, but we will confirm whether or not the bottom is in with the weekly confirmation money flow crossover into the green, okay? Each and every single time the low is in. Now, that doesn't mean you don't go down. You can't drop a little. Each one of these had a really nice drop afterwards, right? Even here with this one with the FTX cycle, you had the weekly confirmation. You still had a move down, and it doesn't look like much, but that is more of a move down than you think. If we throw it on from the time you got the initial confirmation, the green line there, you still got a 20% move to 21% move to the downside. So it doesn't mean you can't pull back, right? You can still have dumps in the market. It just means the low has never been taken out whenever you do get those dumps ever. The low at the bottom of the bear market has always been in. You can see that to be the case way over here too. You got the confirmation, and let me slide this to the side so you can see the wick. Oops. So you can see the wick down and see that it was not violated. I'm just going to move this over just a hair. And you can see when you did get any type of move down, it was not violated. So the low was already in. Okay, let's fast forward to current time, current price, right? And let's mark these out. So we're going to pull the RSI back up real quick, and we'll mark out. We have, in fact, touched the 30 line on RSI. We touched the 30 right there on this. I'll move it to the side so you can see that. I'll put it back. Right on that drop down to 60K, we did touch the 30 line for RSI, which is our kind of our notice to notate that, okay, the low might be in here. It might be in. And what we're looking for is the weekly money flow crossover confirmation into the green. I say confirmation because for 2 weeks, this thing went to green and back to red, went to green, back to red. But it has now confirmed as of 3 weeks ago, and we brought this to you, that we did have a confirmation in the green. And you know what that means? It means never before in history has price revisited the low. Never, 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 never. This stat is 100%. So when you combine these two metrics, you have two 100% stats, right? Two 100% stats that the bulls are in control. Again, it doesn't mean you can't have a little pullback, but it means you have never violated the low. So that is 1 and 2. Okay, so we have two 100% stats for the bull case. All right. Let's turn some of this off, and we will go look at the bear case now. So let's turn off the RSI and the money flow. And the first thing I want to look at, what a lot of people are going to say is, okay, well, we didn't hit a Fibonacci retracement level, 786. We've always hit the 786 fib. And there's going to be a counter argument to that. We're going to take a look at both cases. All right, so in the first bull market, you had the bear market in 2014, 2015. You retraced to the 786, and I just have 786s. I don't have the golden pocket or anything. You retraced to actually below the 786. Same thing in the 2018 bear market, retraced below the 786. Same thing in the 2022 bear market, retraced below the 786. And current bear market that we are in, we did not even retrace to the golden pocket to the 618. We actually front ran the 618. So not only did we not touch the 786, which is way down here about 39K, we didn't even come into the golden pocket in between about 54 and 57K. So this would be a really shallow bear market, a really shallow pull down. We've always got 786 means a 78.6 retracement. We've always gone at least 78.6 percent retrace, and we've only gone about, I don't even know what this is. We could look, but I can tell you it's less than 61.8. 52.5% retracement. So that would be significantly, at least 25% or so less than our smallest retrace. And a lot of people are going to say, okay, but we have a diminishing return, so each return is not as good, so you would expect the drawdown to be less. Well, that's not the case, and that hasn't been the case in any cycle, even though we have had diminishing returns each cycle. First cycle, we had approximately 52,000% run up. Okay, still 78% pullback, more than 78, at least 78.6 pullback, right? Next cycle, 12,800% run up, which is significantly less than 52K. You still came down more than 78%. Third cycle, you only had 2,100%, which is significantly less than both of these, yet you still came down over 78.6%. This cycle, you only moved up 700%, and thus far have only come down about 50%. So just because you've had diminished returns has not meant diminished pullbacks or diminished drawdowns or diminished bear markets. Not yet. Could this time be different? Yes, sure it could. But this is a 100% stat. The 786 is a 100% stat that has not yet been violated. Could it be violated this cycle? Sure, it can. But will it? Will it? That remains to be seen. I actually erased my bull case, bear case. Sorry, I'm rolling with this on the fly here, guys. So we had 2 for the bear case, bull case, excuse me. Bear case, we now have 100% stat, which is our 786s. All right, guys, let's clean some of this up and move on. So speaking of fibs, a lot of people don't use this fib, but I want to draw your attention to this fib that you may or may not have ever seen before. And this is called a trend-based time fib, okay? And we're looking still at the Bitstamp chart on the weekly time frame. Trend-based time fib. You can find it right here under your Fibonacci menu. Right here, I've already got them marked out. We'll mark out the third one, but trend-based fib time, okay? I'm going to turn these on. I've already marked them out for you for the last 2 cycles. You wouldn't have one for the first cycle here in 2014 because there was no previous bear market, not a full bear market anyway. So we don't know where the low would have been here. There's just no previous bull market transition to bear market. So we don't really know how that would play out. So we only have 2 iterations here. And what I do is I put a time-based trend Fibonacci on here at the bear market low to the following bull market high. And it gives me a time-based calculation of approximately how long it would take before we'd be looking for a bottom. And as you can see in the first bear market that we can actually measure in 2018, you just slightly front ran the 382, right? Just slightly front ran that 382. How many weeks? Let's see. We hit the bottom here. We front ran it by 6 bars, which is 6 weeks. So you front ran 6 weeks to the 382, okay? We'll then take the fib from that low right there to the high at 69K in the last cycle, and you can see once again you slightly front ran the 382. I only have the 382, 618, and 786 on here, but you can put whatever fibs you want. How much did we front run this? 4 weeks. So you front ran it by 6 weeks, then 4 weeks. Basically close enough. Call it 4 weeks, the 382, excuse me. Call it to the 382. And let's look at this cycle. Let's go ahead and I'll show you how we throw it on here. We got the trend base fib here. I'm going to mark out the bottom. Boom. Take it all the way to the top at 126K. And that gives us a trend base fib 382 out to November of 2026. Now, another stat that each bear market low is exactly 1 year to the month from the high. You can see here in 2017, we set the high in December, and we set the low, December of 2017, we set the low in December 2018. So 1 year, okay? 1 year. Here in 2021, November of 2021, we set the high. And if you take it out to November of 2022, that's when we set the low. So 1 year. Okay, so that is a 100% stat that, again, is only 2 iterations, but it is a 100% stat in the bear case. So we're going to throw the number 2 there and the number 3 because we also have the stat for the trend-based fib, which you can see, rather than being 4 or 6 weeks away, we are... And actually, if you took it from the low that we've already set, that would be 40 weeks away, which is significantly more than 4 or 6 weeks, 40 weeks away. So if this 100% stat is going to hold true, and again, there's only been 2 iterations, then we are significantly far away from the bear market low. In fact, possibly, I don't know, 22 bars, somewhere in there. So 22 weeks. What is that, about 5 months? We could be about 5 months away, which will put us out into October, which would be 1 month before the 382, which would put us at 1 year from the high, because we set the high here in October of 2025. We would expect the low in October of 2026. So another 100% stat. So far, let's recap. We have 2 bull cases at a 100% stat, and we have 3 bear cases with 100% stats. Let's move on, guys. We have macro support and resistance flips. Okay, let's turn these on here. Wrong one. There we go. Macro support and resistance slips. And I just went back to the last cycle and kind of showed where we came down and set these macro levels, these macro bounce, support and resistance levels, bounce and rejection levels. We came down, big drop here from 69K all the way down to about 30K. Had the big bounce from this area right here. Bounce. When we came back through it, we knifed through it, found another bounce, came back eventually and back tested this area, reject, and down through the second bounce area. Okay. Finally found a bounce here, came back tested it, rejected, came back down and set a new low, knifed through this area here, which I did not mark out. I should have. Here we go. Boom. Right there. And eventually we came back and back tested it, rejected before finally breaking through all of this and running up to a new bear market. Okay. So you had at least 3 levels here that you bounced, flipped to resistance, bounced, flip to resistance, bounce, flip to resistance. 3 levels here, okay? Let's fast forward to current price action, and we've only done this once. So we set the high in October, came down, same dealio, came down, boom, this previous bounce area fell through, okay? So this is bounce 1, bear market bounce 1, came back to the level, rejected, knifed through the bounce area, right? Came down, bounced again, and we're now coming up to this level to back test, okay? Our bounce level back test, okay? We would be expecting another rejection here, okay? Even if you don't come violate the low, we're expecting a good rejection here because it would be unusual. In fact, you've never just knifed through this the first time through without a nice rejection and pullback. And in fact, in years previous, not only did you pull back, you went and set a new low, at least on rejection number 2, which this would be rejection number 2, right? We got rejection number 1 right up here. This is bounce 1, rejection 1. Bounce 2, now we're looking for rejection 2, okay, to come down. So this would be another stat. Did I delete? There it is. I thought I deleted it again. I was going to be like, dude, I'm off it today. All right, so we have 4 100% stats. And again, I know there's only a few iterations in each one of these, but when you're looking up Bitcoin on the weekly, on the macro, there's just not a lot. We have to go with what we have to work with, okay? It's not like I'm cherry picking what to use. I'm using what we have to work with, guys. All right, so there you have that. Let's move on. All right, what we're going to look at now, bear market drop zones. This is where it gets a little interesting, okay? Let's move on to the bear market drop zones. And I think maybe a lot of folks, myself included, have been looking at this a little bit wrong. So you can see we have these levels. We have these like levels in the bull market where we have pullbacks, these zones of consolidation, right? Little zones of consolidation, right? And let's look back at previous cycle, which looks eerily similar to this cycle. We had these zones of consolidation to which we found bounce areas when we came down into the bear market. And what I've noticed in the previous cycle, 2021, 2022, we came down, formed a zone, then came up and set a high. When we finally broke, the bear market started, we finally broke down. We came about, I don't know, halfway, 2/3 of the way through the zone and bounced. Okay? That led to a lower high, moved down to this zone, which we found our way, I don't know, about halfway, 2/3 of the way through, and bounced. Okay, we bounced back up to this zone and then came crashing through that zone before finally setting another low, right? Okay, at the 786. Well, look how similar this is. And I think we may have looked at this differently. But we formed a zone in the bull market, a little pullback, form a zone, move up to all-time high, came down about halfway, 2/3 of the way through the zone and bounced, okay? Boom, came down to the next zone, which we formed during the bull market, about halfway, 2/3 of the way through this zone and bounced. Where did we bounce to, guys? We bounced right back up into this first zone. Could we be rejecting and headed back down just like we did here, right? Come back into that zone, reject, head back down for lower, guys. It is certainly possible. And where would that take us if we did? Where could that take us if we did? It could take us down to confirm one of our other metrics, which is the 786, right? Which we've already looked at. So I'm going to call this bounce zone, this bear market drop zone, bear market drop zones, where we're dropping to the different zones and bouncing from those zones before knifing through. That is another check mark to me in the bear column. That we're just doing what we've always done, guys, which is a bear market rally. And where are we rallying to? So far, we're rallying exactly to the previous zone, which is exactly what we did last time before finding rejection and moving lower. So far, this is appearing to be a bear market rally and not an actual full-blown reversal. Could I be wrong? Sure, I could be wrong. We do have the 100% stats of RSI and money flow, but so far, that's all we have. All right, let's move on. Let's actually take this fractal, okay? Let's take this whole fractal, which I've done before, but I had it drawn differently. Maybe I was wrong prior, but look at this. I took this fractal right here. So the fractal from this bear market, I copied it, and I've moved it over. And guys, look at this. Look at this. Store a fib back on. Could take us right down below the 786, just like every other cycle has done. Just like every other cycle, guys. This is literally, I just grabbed this fractal right here and moved it over here. That's it. We're bouncing from the same areas. We're coming back to the same zones, looking for a rejection and move down, guys. Does it mean it has to come as high as these blue lines? No. You don't have to have candle for candle. The point is the structure. We're looking for the structure, and the structure so far looks exact. So that is another mark. The fractal. Can't call it 100% because it's only one fractal, but the fractal is another marble in the jar for the bears, guys. Another marble in the jar from the bears. Let's look at our diving board springboards. A lot of you haven't probably seen this yet, but let's turn on the diving board and springboards. I call them diving board and springboards, okay? I'm still on the weekly time frame. So this is nothing more pretty much than divergences, weekly high time frame, weekly divergences. When the line, the trend line, which I'm not a big trend guy, but this is how you form divergence. When the trend line is like this, I'm calling that a diving board, right? You jump up, you come down, you hit the diving board, bounce, and then down. Okay, eventually on a macro level, you're going to come into a springboard, which you jump into and you spring out of and really rip up to a new bull market, new all-time high, new whatever, major rally, macro rally, whatever you want to call it. Okay, so as long as you're getting springboards, you're good. As soon as you start getting macro diving boards, you're headed down, even if you have temporary rallies, temporary bear market rallies, okay? All the way down, into the bottom of the last bear market. Even down here, you're still getting diving boards, diving lower, and then eventually you get a local springboard. In this case, you get a macro springboard too. You get a local and macro springboard, and you spring off to a new rally, okay? And as you're going in the bull market, you can see the entire way you're getting springboards, right? Trending down, spring up. Trending down, spring up, right? Springboard. Well, we've now shifted to diving boards, okay? Diving board. We're looking for down. I know it's continuing up, but you can do that. You did it here. Look, you did it right here. You continued up and still jumped up a little bit higher. You don't yet have a macro or even a local, guys. If we zoom in here, we don't even have a local springboard. None of this is a springboard. You don't have any lower lows. Therefore, you cannot have any divergence. You can't have any weekly divergence right here. There's no weekly divergences, right? Because you don't have a lower low to go in here, right? It would have to look something like this. You'd have to come down, set a lower low, right? And then get your springboard there, and you would have something like a higher low and momentum waves right there, or your oscillator. Actually could give you a nice little head and shoulders there too. But regardless, that would create your diving board your springboard divergence, right? We don't have that yet, guys. So this is, to me, another marble in the jar for the bear case, guys. So we're going to throw that up in the bear column. Don't worry. You get to choose, not me. I could be totally wrong, but we do have 7 check marks in the bear column and only 2 in the bull column, but those 2 could be right. All of these other 7 could be wrong, but we're not done, guys. We're not done. What could be, so we're having this nice little rally, okay? It looks great. I acknowledge it looks great. Let's drop down to the daily. What I want to turn on here is the 200-day simple moving average. You guys may have heard of the 200-day simple moving average. We've been talking about it for a long time. A lot of channels have, but it's not uncommon in the bear market to rally to the 200-day simple moving average, even come above it sometimes. But it doesn't mean it's over. You can see back here in 2022, we rallied up to it right here. Boom, rejection, big, massive move down. You even came above it in one of these bounces, but you barely really lost it. So I wouldn't really count this because you just kind of hugged it and then came back above it. Either way, you wound up losing it when you came back to it. But when you significantly lost it and came back and back tested it, you rejected. You actually front ran it. If you zoom in here, you can see you slightly front ran that. You didn't actually touch it, just a little front run there. If we go back in time to the 2018 cycle, bear market here, you did significantly lose it here on the first move down, but really only for, I'm on the day, so 1, 2, 3 days later, the third day later, you reclaimed it. So you didn't spend any significant time below it. And then you lost it, and you back tested it multiple times after that and lost it each and every time. Let's see, lots of losses here. 1, 2, 3, 4, 5 times. And actually, if you notice on these other, you touched it on this first one, but on all the others here, you front ran it, front run. Even back here, front run. You front ran it. So you didn't actually come up into it before rejecting and hit it down. When you finally did come through, way back here about a year later, you busted right through. So not uncommon to come up to this, to rally up to this multiple times in the bear market. And where are we at now, guys? We've clearly broken down through it significantly. I would consider this like that first breakdown where we got in both previous cycles we just looked at. You broke down and only spent a couple days below it and then came back up above it. And once you lost it again, we are just now testing it for the first time. And in fact, front running it just like we did in previous cycles, a front run, which led to lower lows, okay, which led to a lower low in the bear market. So this is another 100% stat in the bear column. All right, one more stat here for you guys. 2 more stats, actually. So what could be the catalyst here, as if you needed another one, besides the fact that we're at significant resistance zones, right? We're at the resistance zone here back in our breakdown level, which we discussed. We are at the resistance zone with the 200-day MA. These are on the macro scale. So what other things could be a catalyst for a move down besides actual resistance zones? Let's go back to the weekly. I'm going to show you a stat that not a lot of people are talking about, and there's only 3 prior iterations, and that is the FOMC swear-in ceremony, okay, where there is a new chair for the Federal Commission for our interest rates, things like that. You know Jerome Powell. Y'all know Jerome. Jerome is leaving office on May 15th, which is in 5 days. And there'll be a swear-in ceremony for the new guy, Kevin Warsh. Okay, and let's look at the 3 previous swear-in ceremonies here back in 2014, excuse me. Janet Yellen was sworn in, and I'm not going to zoom in on all this. You just have to trust me. I can move this to the side, but you had a little run up into it, okay? You kind of ran up into it, and then she was sworn in a massive sell-off. What do we have? The first week after the oath, so when she took the oath, which was on a Monday, that week was a 24% dump, guys. Kind of one of those buy the rumor, sell the news kind of events. The following month was a 51% drop. Even though you rallied up into it, you got a 24% drop in a week. In the month that it was in, got a 51% drop. In 2018, you had Jerome Powell take office, right? Same thing. I'm not going to go zoom in on all this, but you ran up into it. You rallied up into it. Then when he was sworn in on a Monday, you had a 26% drop that week. And that month was a 20% drop, which means you came back up 6% from the drop. So basically a 26% drop, okay? So you had in the first week. First week here was 24%. First week there, 26%. Overall, 51%. Overall, 26%. All right, in 2022, Jerome stayed in office, but there still was a swear-in ceremony, which if I move this, you can see once again, you rallied up into it. It's on a weekly time frame, so it's harder to see how big these moves were, but they were decent moves. You rallied into it right here, about 27% up into it right there. Boom. He was sworn in first week, 7% drop. First month was 42% drop. So either way it went, you could see clearly that you initiated moves down. This was right in there. Initiated moves down. Significant moves down from these swear-ins. In fact, all three, whether it happened within that first week or first month, led to this was here. Led to continuation down of the bear market. All three of them. All three of them. All three of them. Well, Kevin Warsh is being sworn in on the 15th. That's a Friday, actually, and I will challenge this. So right here, when Jerome took his second office, his term expired on Saturday, and they didn't swear him in until that Monday, okay? Jerome's term here expires on Friday the 15th. It wouldn't surprise me if they don't swear in Kevin Warsh until the 18th, which is Monday, but they haven't announced, they haven't said what date it's going to be on, so we don't really know, but either way, whether it's the 15th or the 18th, it'll be that week of the 17th, 18th. That week is what we will potentially look for our big drop down, our big sell the news event. That could be the catalyst. I'm going to put that as a check mark in the bear column. Okay, it is 100% stat. I know there's only 3 iterations prior, but it's 100% nonetheless. One more thing I want to show you guys. Uno más. What will we be looking for to let us know that the bottom is in and that we're going to be springing up out of there, other than the macro springboard that we showed you earlier, right? Remember those? We showed these earlier, diving board springboards. We're going to be looking for the springboard, which would be something like this on the macro level. What else could we be looking for? Let's go to the daily time frame. This is something that's often overlooked. I'm going to turn on our volume on the daily time frame. All right. Let's go back to prior years, and this is previous cycles. Again, the daily time frame on the Bitstamp chart. You got to zoom into the area you're kind of looking for. We're looking for this bear market area. So when we had the top, right? We had the top. We started to move down. We got a big drop. See this big red candle right here? I guess I have my own candles here. I could move down. Big red volume spike candles. See, the rest of the candles, I mean, there's some exceptions, some medium-sized candles here and there, but for the most part, you can see that they're kind of like, sorry, guys. They're kind of like here. I mean, there's kind of tops of them there. Some are a little higher, a little lower. This was in the bull market. And then when you get the bear market, you get this first big red candle down, right? Okay. And that was with this drop right here. Then fast forward, you come down, you get another big volume spike, which is this candle right here coming down. It's a series of candles. It's a few days, but you get these right here, these elevated candles, boom, another drop. And then it's all about like this, right? All kind of lower candles. In fact, declining volume, right? On declining volume. And then there's one more big red candle for a final capitulation wick. So you got 3 big red wicks that stand out significantly more than the others, right? Well, let's fast forward, guys. Let's fast forward. Stay with me. We're almost done. Okay, so we're fast forward, and we're here at the 2022 cycle. Let me make this a little bit bigger. All right. So we had the high here at 69K. From the high, we started our move down. We had one big capitulation wick, one big red volume spike. Then we had a little period of consolidation, then another big consolidation wick, which was this big drop here for a little low. Finally, coming into the end of it, you had declining volume. You can see clear as day, declining volume right here, right? Volume is declining. And then one final capitulation wick, one final big red volume candle, volume spike right here, 1, 2, 3. That ended your bear market. And if we zoom out, you can see it was up and out of there from there and form a new bull market. Okay. So let's fast forward to this current cycle. All right. So we had set the high at 126K. we come down into the bear market. Boom. You can see the volume is way down here for the most part. We had one big red candle that was this nice capitulation wick here coming down. That was the first volume spike. Then you kind of consolidate. Boom, another big volume spike, red volume candle. The second drop in capitulation. And now what do you see, guys? We're rallying back up again, just like every other cycle, on decreased volume. I'm telling you guys, maybe not today, maybe not this week, maybe not next week. At some point in time, you're going to get, in my opinion, this one more big red volume spike candle. And that's going to lead to one more capitulation wick to the downside, guys. And nobody is seeing this coming. Everybody's just thinking it's up and out of here, might get a small pullback, and then we're gone. This time is different, blah, 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 blah. But this move up, guys, is on decreased volume. This means there are no buyers stepping in. This is mostly fueled by liquidity. People are being stopped out. Every one of these little wicks, you're finding shorts pile in. And all you have to do is just ever so slightly move price and liquidate or stop them out, which triggers a series of buy orders, but they're not actual buyers. You can see decreased volume, which means this is a recipe for a massive nuke to the downside, guys. So this would be yet another check mark in the bear column. And that's it, guys. I can present you with two statistics that are 100% that the bottom is in and that it is bull market on. Of course, you can get some little pullbacks here and there. It doesn't mean it's time for the moon. There are two. The money flow and the RSI indicate that the bear market bottom is in and that we will not violate that low. However, there are 10 other stats that say that the low is not in. 10 other stats. So either way it goes, there will be multiple stats. You will either have 10 stats that are violated, 10 of them that have never been violated before that say that the low is not in, or you'll have 2 that are violated, the RSI money flow. Either way it goes, there are going to be some 100% stats broken. It is up for you to decide. Is money flow really king? Or is this too much for even the king? That's for you to decide, guys. It's just for me to present the case. Bear case versus bull case. Who will win? You decide. Let me know in the comments below. I appreciate you guys. I love you guys. I will see you next time.